So thank you so much, everyone, for joining us today. We would be starting a webinar on the topic of integrated balance sheet and covering the risk management. And what we have today is Mr. Kevin, who is the Chief Risk Officer of Fidelity Bank. And also joining us is our director, Mr. Satya Vemeledi, who's going to take us through the webinar. I also welcome President Mr. Magnus Noka, President Remand and Chief Risk Officer of Coronation Bank. I will invite Mr. Magnus to, do a welcome note before we start on the webinar. Over to you, Mr. Magnus.
Good day, good morning, distinguished participants from across the globe. On behalf of Aptiva and Women, I gladly wish to welcome all of us. This all-important webinar. This is the second in a series of a growing partnership between Riemann and Aptiva, and we have centered on ensuring the right risk culture, increasing the capacities and competencies of our professionals in risk management to weather this stormy environment. As we see increasing risky business environments, organizations have no choice but begin to take an integrated approach to risk management across all activities. I will not want to preempt the speaker on this team, because I know we have a very strong speaker this morning.
Forget that story. Let us begin.
Can we mute us all, everybody? Can there be mute everybody? Because there's a lot of background.
Honestly.
Okay, I was saying a speaker we have this morning, a friend and a brother of many years standing, who in all ramifications is eminently qualified
Magnus, you're muted. You're muted, Magnus.
I wouldn't know where I stopped, since I think at the point I was muted. But I will just recap that we have a very eminent scholar this morning who will lead us in this discussion. I will do less of his introduction. I'm sure it will be handled at the appropriate time. I will only want to welcome all of us to this exciting time, and hope at the end of the session, we are going to have an enriched time out here on this webinar. Once more, I appreciate Aptiva for providing this support. And of course, us in Riemann is also part of the objective we have set out for the association, to enrich our members and the general public on the issues that matter every day in our times. Once more, thank you all, and I wish you a very successful webinar session. Thank you.
Thank you so much, Magnus, for the welcome note. Now I'm going to request our director, Mr. Satya, to take us through the webinar. Satya, I'm going to make you the host now.
Yeah, sure. Yeah. I hope my my screen is visible to everyone. Pratik?
Yes, it is.
Yeah, okay, thank you. A very good morning to everyone, and thanks for joining us today. And I thank Mr. Kevin Magnus who has given us this opportunity to share our experiences in this area, having been in the space, myself personally having been in the space for the last 13 years, focusing on balance sheet management, from various capacities, being a banker, a consultant, and a product or a solution vendor. So I've been part of many ALCO discussions as an external and as an internal participant. And so having gathered this knowledge, and now currently with Aptiva, I'm leading the advisory and analytics solution offerings from our subsidiary Cognext in the space of balance sheet management. So without taking much time, we'll just right away jump into the topic. So the agenda is, first of all, as Mr. Magnus already mentioned, so that the time right now, the situation that we are in calls for, a collective view, a collective responsibility and integrated view of how we manage banks. And a key or a fundamental block of managing a bank, starts with your balance sheet management. So, at the most fundamental level, banks are essentially, the financial intermediaries within an economy, and they are the ones who, are the gatekeepers of the flow of cash and liquidity within the economy. And they bring in deposits from where there is excess liquidity and deploy the funds, where there is a requirement for growth within the economy. And the maturity transformation, which makes this entire exercise possible, is the core aspect of balance sheet management. Of course, I mean, we have three, usually from a universal banking perspective, you have three areas of, sources of profit, starting from the maturity transformation, where banks raise short-term funding and give out a longer tenor, loans based on the borrower requirements. So that the spread that is made, so that's the transformation, maturity transformation spread, or the NII spread, or the ALCO spread, whichever way you want to call it. So that is a major source of, component of the overall profitability of any bank. And then you have the credit margins that the business earns when they, issue loans and assess customers based on their creditworthiness and charge the appropriate spreads. And then the third one is investment activities, in the markets. And so far, so I'm just trying to set a context. I know we are still, we are trying to set the agenda here. So the idea is, so far only at the most senior level of the bank, starting from the board and then executive committees, usually there is a full view of what's happening in all the areas of the balance sheet. It rarely happens that even below the executive committees, even within critical committees like ALCO, you don't really know what's happening on the credit side, on the operational side, or what kind of how the bank wants to achieve the growth that has been set aside. So ALCO sometimes has mostly has a view of the business plans, but they don't necessarily have the view on how it is being executed. And so we think that we need to bring the same level of view that the senior most level of the banks has, to at least to the mid-management level, to make banks more agile and more responsive to risks. And that kind of, because as the org structure of banks usually is an apex form or a pyramid form, where a few people at the top, and as you go down the chain of command, you will see more number of people. So as you go down the chain of command, it becomes much more difficult to coordinate various risk and business making activities. And this is where recent analytical technologies and automation play a key role. So we'll look at that. And when we say, so the point of I'm trying to make so far is, the need for integrated balance sheet management, not just at the most senior level of the bank, but also at least until the mid-level management of the bank. So everyone is aware of what's happening in all the other silos, before they make their own decisions and recommendations to the senior committees. And then we, as I mentioned, so we tie in this integrated balance sheet management, how it ties into business strategy and planning, and how we can bring in the risk linkage into this process, and what kind of challenges a bank would see when trying to adopt such a more granular integrated balance sheet management framework. And then a couple of ideas in terms of how banks can take a step forward in this direction. So that's the agenda that I plan to take you through today, and I hope it's interesting to all the participants, and there will be active participation from you. So starting with the need. So in the context I set, obviously we have highlighted that the current scenario. Well, the current scenario has actually started not just with COVID, but way back in 2008 with the great financial crisis, as it's being called now. And regulators worldwide have started putting greater emphasis on risk management, and a number of recent regulations focusing on balance sheet management, from interest rate risk on banking book, the liquidity coverage ratios and net stable funding ratios, the leverage ratios, and additional requirements for comprehensive assessment of capital and liquidity, so on and so forth. For some time, there's been a lot of criticism, on the regulators that, too many regulations are coming in too quickly for the banks to be able to make sense of what's being measured and how to respond. But the fact of the matter is, COVID-19 has shown that these regulations have definitely played an important role in stabilizing the systems, despite the, steep economic impacts that the pandemic has brought in. Especially, I would say, being a practitioner on the liquidity and interest rate risk side, I would say on the liquidity side, you don't see too many challenges these days. Specifically given that there have been strong regulations in the liquidity space. But of course, only time will tell whether how this pandemic will play out, and what kind of impact it will have going forward. Obviously, the global financial crisis, or the great financial crisis, was largely focused, although from an initial trigger, it has been a liquidity driven crisis, where most of the markets, even in the highly developed markets, have dried up, leading to collapse of many tall banks, or banks with great legacy. But what then happened over a number of years past that is that the economies have gone into at least certain level of recession, because of which there has been credit impairments on the loan portfolios, and a number of economies are still reeling from the provision bookings from that point in time. So with that context in mind, but if we come to the COVID-19 right now, what you see is COVID-19 essentially has put a stop on the business activities in the economy. And most people are, putting their money in the banks, and they're not doing any purchases or any economic activities with the money. So from that perspective, from a liquidity perspective, banks have not seen significant impact, although from secondary banking markets and non-banking financial institutions have definitely seen stress during COVID-19, but banks themselves have more or less been able to meet the liquidity challenges. But what's not addressed so far is, because of the steep decline in economic activity, there is going to be a long-term impact on the credit side. Just like how liquidity was a trigger for the financial crisis, we think that credit risk is going to play a similar role going forward, and we have just seen the start of provisions being booked across jurisdictions, and that is the reason why it is very important to understand how your balance sheet will evolve over the next few years. What kind of recovery plans are the economists projecting, whether it will be a V shape, whether L shape or a U shape. So whatever it is, banks should be in a position to model their balance sheets and evolve their balance sheets as per the defined plans, and then take appropriate actions. So this and the problem with the kind of response that is required from banks now is, so far banks have seen only a kind of reactive frameworks. From a risk management perspective, we have only seen reactive frameworks which address or which try to firefight rather than proactively model and proactively understand the balance sheet and proactively take decisions. So what has happened so far is that business lines are given targets based on the budgeting activity. They go out into the market, and of course within certain high level parameters of risk and direction, they do the origination activity, and whatever is the outcome of that origination activity is given to risk and finance to manage, in terms of whether that origination would meet the NII targets, whether it would still be within the risk appetite limit set by the board, and if not, what kind of mitigation actions can be taken. And specifically, the point I want to highlight is the balance sheet, the shape and structure of the balance sheet is not arrived at by active design in terms of what kind of tenors, what kind of composition, what kind of funding structure that is required to support that kind of asset origination. So there is very limited, thinking at a mid to, at a mid management level that goes into these activities. And obviously, as I mentioned, treasury and risk are then forced to take hedging actions, or considering other kind of funding actions like long-term issuances to cover for the gaps that come out of such origination activity. And one other important aspect that is usually not considered is the fund transfer pricing framework. So this is again a very important factor in being able to proactively manage the balance sheet, because transfer pricing, a good transfer pricing framework which has been set up will be a kind of a beacon or a light post in terms of how, in terms of the pricing of both your assets and liabilities, without which it's mostly driven by the market. So the salespeople and the the deposit booking organizations or the business units within the bank are driven mostly by competition and how other banks are booking in the market and trends prevalent on that day, rather than looking at the big picture and understanding what are the risks inherent in those positions, and whether the price that is being booked is covering for those risks or not. And in the short term, this may not be an issue, but over the long term, when you look at the valuation of the bank, this will gradually erode the valuation. And that is where Basel has brought in the long-term view of interest rate risk, which is the economic value of equity. We'll look at it a bit later. And a proactive strategic balance sheet management framework involves certain items, activities like business lines work within the overall growth targets, but also risk targets, and they understand what is the risk inherent in the positions that they are offering or originating. And the overall plan for the balance sheet composition and growth should be arrived at in close coordination with the risk and treasury, other than usually finance and business who are involved in the budgeting process. And it is very important that funding strategy play a key role in driving the business planning process, because origination usually, a lot of focus is spent on the asset origination, but more and more liability origination and maintaining a stable funding profile is also becoming key to ensure that there is stability in earnings and the risk profiles over a long period of time. And so essentially, and these kind of coordination, will come, it will start at the board level when the risk appetite is set, and then it is cascaded down to the XCOM and the ALCO, which plays a very critical role. And the important aspect is then to push a similar view down to middle management within risk, finance, and treasury. And to and one more additional point is a favorite framework in risk management is the 3 lines of defense framework, where usually it is said that the first line books the or originates the positions. The second line then reviews or monitors and measures the risk, and the third line of defense then reviews the overall processes that went into originating and managing those risks. But unfortunately, the current scenario does not give that kind of cushion or position for banks to take their time in first originating the book, and then risk coming into the picture and looking at the portfolios. So there has to be a mechanism where risk and finance are involved in the origination process, and at the same time the processes that are ongoing are actively monitored by the third line of defense, which is the internal audit. And as we go along, so we will also try to evolve a framework that tries to achieve this kind of close coordination. So in terms of the need for integrated balance sheet management, so as we have seen, there are a number of evolving regulatory requirements, and post COVID-19, you can rest assured, you can bet that there would be some additional regulations that come in, or at least tightening of existing regulations that go into either provisioning of the positions or from a reporting perspective. And so banks need to be able to meet the regulatory requirements, not from just from a reporting perspective, but also maintaining the positions in terms of capital, liquidity, and leverage. And the second aspect is meeting the customer franchise requirements. So it may be that the current scenario is challenging, but that does not mean that banks who are universal and full service can stop offering certain critical aspects of their portfolio because of their perceived lower benefit or higher riskiness. For example, wholesale funding, for example, wholesale current accounts. So they are usually considered as highly risky, and obviously compared to the retail side of deposits, they attract a higher level of runoffs. And despite the scenario and despite the riskiness, banks cannot simply stop offering such products. They'll still have to accept all those deposits, and they'll still have to manage the risks involved on those deposits. But there are other mechanisms to control it. Like, for example, in Europe, a number of banks have started charging negative interest rates. So that means the depositors themselves pay money to the bank to hold the deposits with the bank. So there are elements there that banks need to consider, which products and which lines of business should be the focus, but at the same time without losing the overall focus on the customer franchise. And the third aspect is the shareholder requirements. I mean, shareholder requirements primarily come from a short-term earnings perspective and a long-term valuation perspective. And most of them, often than not, the short-term perspective overrides the long-term perspective. And because of that, there could be a number of contradictions in terms of the requirements that shareholders require compared to what your customers require and compared to what the regulators require. So the integrated balance sheet framework should look at all these aspects and expectations of each stakeholders also, while optimizing the balance sheet and evolving the balance sheet over a period of time. So that ends with I mean, that section. What we have just discussed is about setting the context and why banks in the current scenario need a more coordinated approach to better plan the growth. And then we move into the next area where how do we tie in this kind of an integrated framework in business strategy and planning. Before that, I will probably request Mr. Kevin to share some of his experiences during this time, and whether he agrees with the kind of scenario that I've been describing. Mr. Kevin, if you may.
Yeah, thanks a lot, Satya. This has been very, very. So I'll just go straight to the point because of time. Yeah. I think what you've said captures what's the experience generally. Indeed, to a large extent, there's some element of reactiveness to the way the balance sheet is managed. So what you're proposing is something that is more proactive, and I think that would be very good. What you do find in a lot of banks is that, yes, you have an ALCO that looks at the balance sheet, both foreign currency, local currency aspects. Now, this translating the effectiveness of ALCO to each, okay, a lot of banks are divided into, subsectors. You have the bank itself, then you can have a directorate or a regional bank, which is a collection of some branches. Now, translating that management of their individual balance sheets, that will be something that will be very useful, so that whatever decisions they are taking, whatever, whether it's on the liability side or on the asset side, they are conscious of managing their balance sheet. So I think this is very, very useful. As time, I'm sure towards the end, we'll discuss a bit more about the challenges between the customer perspective, regulatory, and the bank's perspective. But for time, I will just move on and let you continue.
Sure.
Thank you.
Thank you. Thanks for the comments. Yeah. So when we we are now trying to see how banks can build their strategy and take the planning and cascade the planning down the chain of command, and how such an integrated approach can be brought in. So if you ask me, how do you define strategy? So what is strategy? So strategy cannot be articulated with a single statement. I mean, usually strategy is something that is expressed in the form of the appetite statement that is set by the board. And that strategy incorporates various views of how the board wants to see the bank grow in the future, and what the bank thinks its strengths are, and where it could be in the near future, in the medium term, in the long term, and what sort of segments does it see itself servicing, and what kind of need in the economy is it going to fulfill, and whether it is going to retain the trust of all its customers while doing so, and in an efficient manner. So essentially, strategy covers these aspects, and at a high level, there would be a qualitative way of describing these aspects, and then when that qualitative aspect is cascaded down, it needs to be broken down into quantitative aspects, without which it will be difficult to monitor and track and set targets. So at a high level, so as I just mentioned, so direction is a key element in terms of how the bank wants to position itself, what is the proposition that it has for its customers, what all types of products that it offers, which sectors it wants to focus on. And this is usually set at the highest level of the bank, usually the board level. Of course, I mean, with participation with the executive committee and the senior management. And then the next key element is the growth. So while direction is something that is very specific to each institution, and it may change its direction based on its own changed circumstances, like for example the shareholding structure has changed, which may bring in a different view, or maybe the management themselves have changed their view, that they see a potential opportunity in a different direction. But so for direction is something which is more or less in the hands of the management of the bank. But coming to growth, growth is essentially what is the growth level that you're expecting in your loan portfolios, in your investment book, in your in your customer deposits, whether you are going to issue additional funding instruments in the market, and from a position balance sheet size perspective, as well as your profitability and NII perspective. And this is largely it has to be in sync with the current economic environment, and that requires that banks do a regular review of the operating environment and all the aspects that like for example new regulations, new legal changes, new potential sectors of investment, potential for growth within an existing segment, potential for issuing a new kind of product. So all of these need to be taken into account while setting the growth. And of course, in the near future, what are the macroeconomic environment? Like, for example, whether there is a consensus that there's going to be a moderate to good growth during the planned period, or whether there would be a recession. So that strongly drives how the growth targets need to be set. And this is one, again, another area where we have seen, most banks lack a quantitative framework to define, that kind of a metric in terms of the growth. I mean, definitely more advanced economies, we see banks have a number of models, big teams of economists sitting, which who argue and arrive at a consensus that this is going to be the growth rate for the next year, and therefore these are the products that we need to be looking at, and these are the segments. But if I mean, probably, it makes sense for $1 trillion balance sheet bank to have such kind of infrastructure. But medium to small banks and banks in emerging economies need to have a more agile framework, possibly through automation, to be able to understand by looking back and also by looking at the current understanding of the scenario, and then be able to take or cascade this growth down the chain of command and define the specific numbers. And in terms of efficiency, of course, this is always an ongoing process. But in terms of efficiency, although from a capability perspective of whether the efficiency has been increased in terms of direct, indirect expenses, your cost to income ratios, the service quality and levels, all of them involve a lot of operational aspects. However, from me personally coming from a control function kind of risk and finance background, efficiency, still finance and risks play a big role in driving efficiencies, because when setting the profitability or performance measurement frameworks, it becomes very important to identify the key cost drivers and then link them to the profit centers to drive, not just drive the efficiency, but also the more important aspect, which is the ownership and decision making. So, when, for example, when a large expense is being made, in terms of whether it's a system or an advisory project, if the benefits of such an exercise are not identified and the a realization of such a benefit is not assigned to a person, and when there is no joint consensus within the senior management, so in all these cases, without those specified things, you will not be achieving the efficiencies that are desired. So still, risk and finance have a role to play in bringing up efficiency levels. And then the health, of course, this is the focus area of risk management, whether you are able to measure and monitor the risks accurately, whether you are able to set the limits, the operating limits and maximum tolerances in the right manner, so that they don't adhere the growth, but while at the same time also take into account various hypothetical and possible realistic stress scenarios, and the bank is able to survive those kind of scenarios. So, I mean, in terms of discussion around strategy, these key four pillars, very well define how one can look at the mind of a senior manager, mind of the senior management as it sets its strategy. And then in terms of the framework of how do we operationalize such integrated view, which is there at the top, where you are looking at health, your your growth, your direction and your efficiency. But as you go one level down, growth has already been set up, based on, the initial analysis. The direction has also been set up, but obviously what's not, still in consideration is how the evolution of balance sheet changes, dynamically, whether there'll be change in compositions. So that's the purview of ALCO, which looks at the the balance sheet composition and pricing aspects. And efficiency goes totally in its own silo. Risk management usually goes in its own silo. And because of which, as I mentioned, that level of integrated view is not available at a mid level of the management. So in order to achieve that view, obviously we start with the, these are the key aspects that are required. One being the risk appetite statement. So risk appetite statement, it should be not only have qualitative statements, but as I mentioned earlier, they should have sufficient quantitative aspects that can be monitored and tracked, and then can be given down to the chain of command. We'll come into a bit of details in subsequent slides, and then we come to a well-functioning ALCO who is actively and dynamically managing the balance sheet, rather than taking a view of annual review of the composition or annual review of the risk position. ALCO needs to become much more dynamic in its approach of maintaining the balance sheet composition, especially in times like these where the market itself is evolving very quickly. And then we come to the business organization or the sales organization, where the origination needs to have some kind of guidance from risk in terms of pricing, in terms of the tenors, in terms of obviously, I mean, when positions are evolved, there is assessment of the customer from a credit perspective, which is taken into account. But from the account of capital adequacy, from the account of whether this adding this position, what kind of impact will it have on your liquidity profile, not just today but over the course of time, what kind of impact will it have on your NII and your sensitivity to movement in interest rates. So these kind of aspects need to be brought in, and tools should be available with the business, and also with the team that assesses and the approvals of these originations. And then we when you combine the aspects of what the board wants from a risk appetite, and whether it has been cascaded sufficiently granularly for the mid-level management, whether there's a dynamic ALCO that is actively looking at the balance sheet and repositioning. And when I mention dynamic, mostly what happens is ALCOs are convened on a monthly basis. And by the time the ALCO convenes, the reports that are presented to ALCO are usually 1 month to more than a 1 month old. And because of which ALCO is making decisions on a lagged basis. And in times like this, 1 month can be, quite a huge time frame, and during which a number of things could have changed, especially from a liquidity perspective, and also from interest rates risk perspective, where there has been significant movements in the interest rate regime that is prevailing in the market. So that's the active management of the balance sheet. And then the third aspect is the origination itself, which needs tools to understand what ALCO has, what the risk appetite wants its balance sheet to have, and what actions that ALCO has recently taken, and how those decisions can then be guided in terms of risk sensitive origination. So these key three aspects form the core of integrated balance sheet management. And how we can operationalize these, we will be looking at it. So starting with the first component, which is the risk appetite statement. So risk appetite directly derives from the strategy. And while while strategy looks at where it wants to be, both in terms of growth and health, risk appetite articulates the key elements of that strategy. So some we've tried to present here what ideal or a typical risk appetite statement would look like. Essentially it will have both qualitative and quantitative aspects. And in terms of qualitative, it will be talking about strategy and direction. And in terms of quantitative, it will be talking about specific limits and specific tolerance levels of various KPIs. So starting with capital adequacy and the credit side of the business, where you want to have the right level of common equity tier 1 ratios, which are now actively managed by most regulators. This could be tier 1, CT1, and the overall CAR, including pillar 1, pillar 2. So these come in a number of varieties. And then the leverage, where what is the level of leverage existing within the bank. So what kind of capital to lending position that the bank has built up, taking advantage of the capital. And then in terms of the overall target rating of the bank's portfolio, and thereby deriving its own credit rating. And then we look at the stability of its growth parameters. So that means the planning needs to be sufficiently long-term, and it needs to include not just normal but also stress situations, so that there is no significant volatility in terms of earnings. At least so when businesses plan for raising, let's say expanding a particular business, or expanding into a geography. So those kind of decisions, and especially also on the side of dividend uh, dispersal. So all these activities need to they need to be planned sufficiently far from each other, and at the same time the funding side also needs to take into account those kind of decisions, so that it does not suddenly impact earnings in 1 year and raises the earnings in another year. So these kind of things, not just the level, but also the volatility itself has a lot of impact on how the creditworthiness of banks is assessed by most rating agencies. So it becomes very important that the volatility in a lot of these metrics also be managed. And of course, a number of other metrics like return on capital, return on risk-weighted assets, the cost-to-income ratio, the IRRBB exposure appetite. So all of these aspects, derive from the lumpiness existing in the balance sheet. When I mean lumpiness, whether in terms of asset concentration, whether in terms of liability concentration. So when I mean concentration, it could be concentration across the tenors, what's maturing in 1 month, what's maturing in 2 months, so on and so forth. And the concentration in terms of sectors, the concentration in terms of single names, and how changes in any of these might impact your liquidity, your interest rate risk sensitivity, and thereby increase the volatility of the overall profile of the bank. So that's the stability aspect, and then we can define a number of metrics that look at this, and then the other important aspects other than capital is the liquidity and funding side of the story. So banks are already familiar with the number of these ratios: the liquidity coverage ratio, the net stable funding ratio, the composition of HQLA, and the encumbered and unencumbered portions of the HQLA, various other ratios like loans to deposits, which tend to see what kind of capacity exists in the market for lending. And then certain other limits that you can impose when you look at early warning indicators, when you look at risk factor wise limits. So for example, liquidity from a internal liquidity adequacy perspective, you when you quantitatively try to measure liquidity risk, you look at 8-9 key aspects. What's the retail funding risk? What is the risk that whether existing retail fundings run off, or whether you are unable to grow any new retail funding. Wholesale funding runoff risk. Then deposit concentration risk. Deposit pricing risk. What is the risk that the earnings of the bank will be steeply impacted because of a change in the funding rates. Off balance sheet risk. So what kind of shadow assets are existing within the banking book, like undrawn commitments, or LCs or LGs that have not yet been called, and additional aspects like step-in risks. So step-in risk is a new category of risk defined by Basel, where the bank may not have contractual obligation to step in and pay on behalf of an entity, but because of reputational issues, it may be forced to. So a number of shareholdings which are not significant, not consolidated, but nonetheless play an important role in the reputation of the bank. So in those cases, bank may be forced to step in. So those kind of eventualities. And also, of course, as Mr. Kevin mentioned earlier, when banks are spread across jurisdictions, risks in certain jurisdictions may spill over to other areas, or maybe because of change in regulations, banks may not be able to freely transfer capital and liquidity between the jurisdictions. So risk appetite needs to ensure that each element of these risk factors are taken into consideration when setting up the appetite. So there needs to be a key set of ratios that are monitored at the board level, like for example, the capital adequacy, the overall capital adequacy ratio, the CET1 ratio, LCR, and SFR. But there need to be a number of other ratios which are managed by EXCO and ALCO, just below these higher levels, in the lines of what we just discussed. And then the last aspect of stakeholder confidence. I mean, this is mostly a qualitative aspect. Of course, there are a lot of operational metrics that one usually sets up, in terms of turnaround times, service quality level assessments, and customer satisfactions, or sentiment analysis prevailing in the market, or credit outlook provided by a number of credit rating agencies. So a number of such items need to be monitored, at least, and any negative aspects observed in any of these areas needs to be considered as a breach. Whether there is a public sentiment against against its from its customers, maybe there is negative sentiment among employees identified by HR, or there are some MRAs or fines by the regulator. So all these kinds of items need to be incorporated at least at the second level of the risk appetite. And that brings to the mandate of ALCO, the second aspect. So once the management has set up what it needs to monitor and what it needs to measure in terms of the risk appetite elements, then it comes down to ALCO to actively guide the evolution of the balance sheet. And ALCO is increasingly recognized as being pivotal to the success of various banks, and many regulators are forcing that ALCOs meet at least on a monthly basis, and the minutes of meeting are shared with the regulators. And of course, I mean, that is because ALCO typically looks at all the key aspects or the key pillars of the health of the bank and the direction of the bank, starting from capital management, whether the internal capital generation is sufficient for the growth of the bank, whether whether any additional capital needs to be issued, or if it is issued, what is the impact of it, what kind of timeline should the ALCO adhere to. Coming to liquidity risk, so all the aspects that we just discussed in the previous slide. And interest rate risk management. So this is another new regulation that Basel has, the BCBS 368 regulation, where now banks are not only required to be measuring the short-term sensitivity, which is the net interest income sensitivity to change in interest rates, but the long-term valuation itself, the economic value itself, and how economic value may be eroded if pricing decisions are not right currently. So those metrics also now form part of the risk appetite of many banks, and these are actively managed by ALCO. And one, if I may say, a new and something which has becoming more and more critical is the capability to quickly turn around what if scenario analysis and contingency plans. Of course, I mean, because the market itself is changing so quickly, usually, historically or traditionally, what happens is ALCO, deliberates on a kind of decision, whether to go for a new product, whether to go for a new issuance, whether what will happen if the interest rates change as per a Fed guidance that is imminent, or things like what will happen within the next week if oil prices see a shock, and what will be the impact if OPEC has decided that it's going to lower its the cost at which the price at which it sells oil. So a number of such scenarios have a real impact on the balance sheet, if not in the short term, definitely in the medium term. And ALCOs definitely need to have a very clear picture of how their banks and its balance sheet and the profitability get impacted because of such scenarios. But currently there is no integrated view of how such an analysis needs to be conducted, because the business plan is managed by finance. The risk metrics and the analytics in terms of measuring the customer behavior as a response to such scenarios is managed by risk. And treasury or the funding desk who actively manages the position looks at a very relational view of managing the balance sheet, and mostly takes sometimes it may be a profit center, but most often than not the ALM center or the treasury is not a profit center. It's a cost center, and it's a very reactive approach to managing the balance sheet in terms of hedging, and it's completely driven by ALCO's decision making. So in summary, so ALCO has a very crucial role to play in all these aspects, that it needs to ensure that it is setting the right governance and risk framework and assigning the right responsibilities, and not just from a normal BAU or business as usual operations perspective, but also and especially during times of stress, nominating a crisis management team, defining their roles, defining the key steps or sequence of actions that such a team will take in times of a crisis, the backup plan if certain members are not available, the lines, the funding lines available, contingency funding lines available, and the contact numbers of key stakeholders required to manage the funding and the media. So all these form part of setting up the right kind of governance. And then, of course, ALCO plays a very important role in review and feedback and aligning the risk appetite to the active balance sheet management. Because at the end of the day, ALCO is the one who has the complete view of the balance sheet and is actively managing all these metrics. Liquidity risk, we've just discussed, both in terms of not just the asset side, which is what kind of liquidity buffer the bank holds, but also from a funding perspective, whether the current funding structure and the projected funding strategy, will it be able to support the required growth. And then coming to the interest rate risk side, again, we've just discussed the EV and NII approaches and taking decision in terms of interest rate risk hedges, whether the bank needs to go for a natural hedge, that is to issue funded positions like long-term debt issuances, or reduce the repricing frequency on the asset side, or whether to go with artificial hedges like entering into interest rate swaps to manage such a risk. And market risk is something usually not under the purview of ALCO, but at least from a limit managing perspective, or looking at it primarily from an FX perspective, that is where the mandate of ALCO comes in from. And as Mr. Kevin mentioned earlier, ALCOs do look at currency-wise books and currency-wise metrics to ensure that there are no significant mismatches between the currencies. I mean, especially if the currency markets are not very liquid, so it needs to take special consideration, in terms of bridging the gaps, in terms of which currency your funding is coming from and which currency it is going to, in terms of the lending. And the business performance, like through fund transfer pricing and cost allocation, ALCO is the committee that drives the performance measurement of the bank, whether it is at a product level, a segment level, line of business level, branch level, or at the individual ultimate customer level. The profitability. So this view of profitability is what then drives the direction and the risk appetite setting. So this is a very critical aspect of ALCO, which is usually not highlighted. And of course, in terms of the overall product structuring and pricing, ALCO plays a key role in approvals of the structure of the product, what kind of tenors the product needs to have, what kind of pricing basis it needs to have, which curves should be used for pricing, whether the product aligns with the strategy of the bank. These kind of reviews are looked at. And we have also discussed capital and the overall direction that derives from all these analysis. So I mean, a few examples on a regular basis that ALCOs should ponder to make the balance sheet management more dynamic. So some kind of regular questions, whether the funding mix that is currently there, is it optimum, whether high cost paying deposits can be dropped, or whether certain longer tenor asset portfolios can be curtailed, so that the funding then will be the right mix to support the stability profile, whether the governance infrastructure is enabling the proper measurement. So usually you will know that something is not correctly set up only when something goes wrong, or when you see an adverse impact. The key question is whether such experiences are taken into account and incorporated in enhancing the governance framework, in specifically in terms of setting the key key responsibilities, primarily from a pricing perspective in scenarios like this, whether the deposit raising departments and the funding desk and the treasury, do they have certain decision making authorities in terms of pricing to actively manage any funding gaps, whether there has been any delays in such critical decision making due to non-availability of members, or because rules dictate that certain approvals are required. And of course, there needs to be a balance in terms of what's the level of freedom that a certain level of management enjoys, and what are the risk controls around it. Some of these aspects we just discussed. Probably a few additional items would be ICAP and ILAP. These are two newer regulations and reporting requirements that play a very key role in managing banks. Although these are annual exercises, they at least from a framework perspective, they play a very important role in bringing together all these elements. So we'll look at these aspects shortly. And in terms of optimization of the balance sheet, so these are a few areas that we can classify in terms of analytics that ALCO needs to look at. It needs to build capabilities to identify risk optimization opportunities. So for example, is there additional scope for risk taking? That means you need to have a very clear view of the balance sheet in terms of not just the contractual positions, but also the behavioral profiles, because behavioral profiles play a key role, how you measure your NII, how you measure your economic value of equity, and whether the regulatory level of LCR and NSFR is the right level for the bank, or does it need a higher level of LCR and NSFR, given internally management has a better view of the funding structure and the concentration. So a comprehensive computation and monitoring of these metrics should give ALCO the view of whether there is additional scope for risk taking. It should be able to easily identify whether the budgeted growth is within risk appetite. Usually, these kind of activities take anywhere between 2 to 3 weeks. Once the budget is ready, someone needs to go and put that budget through risk analysis, and then that risk analysis needs to be distributed across credit, across liquidity, across interest rate risk. Whether in place of all this siloed analysis, whether there is an integrated platform which can when someone from the ALM desk inputs the budget growth, whether there is an automated process which can say that given this budget growth over the next 1 year on a monthly basis, this is how your key metrics will look like. And these are the areas where the business plan needs to be amended to ensure that the risk metrics are at the levels that are required. And similarly, from a stress impact perspective, so ILAP is one area which gives a 360-degree view of liquidity risk from a management, from a systems, from a stress, from a business as usual perspective, and from an organization perspective. What the structure of the organization, whether it is a distributed entity, whether it is a single entity, at a group level, at a subsidiary level, whether the current level of liquidity is adequate, both in terms of the normal growth as well as the stress scenario that may be faced anytime during the next planned horizon. So given that, whether the liquidity buffer is sufficient, whether it should be increased, or alternatively, if possible, whether it can be reduced. And if it can be reduced, what are the positions that can be removed so that at the same time you are enhancing the yields. So these are some key kind of questions. We have talked about hedging, We have talked about product structures. We have also talked about optimal funding structure, and something from a liquidity perspective. One more key important point is the survival horizon. So if there are no additional external sources of funding, will the bank be able to sustain itself, and for how long? And both under normal situations and under stress situations, whether the bank has analytical capability to get these kind of analysis on demand, whether ALCO has kind of a dashboard view to this kind of analysis. Then we look at the profitability enhancement. I mean, this is where the core area of performance measurement comes from. Which are the sectors which are more profitable? Can you identify the top 10 costliest deposits? Can we not roll them over this time? Can we instead go for a new new relationships, or whether we can curtail certain growth on the asset side to reduce so that the overall profitability improves. And is there a possibility that you may discontinue a particular line of business which is leading to higher losses? For example, SME is one category which usually is very sensitive to credit fluctuations and market fluctuations. So from a profitability perspective, so these are the areas. And one key area in this space is whether capital deployment is optimum, into the various business segments, based on whether it reflects the the kind of returns that those business segments generate, or whether is there scope for redeploying the capital so that there is higher growth in segments where there could be higher returns. And then one level lower or deeper is identifying the valuable customers themselves in all these analysis. So I mean, certain key questions like, are there depositors whom with the right incentive can be made to become more sticky and increase the length of relationship with the bank? Who are the customers who regularly roll over their deposits? And who maintain an average, deposit balance, a higher average balance. So usually, this kind of analysis is only done at max, once a year, or whenever a new, a scheme or a product scheme is launched, to see, maybe a lucky coupon or a lucky draw is announced, and the overall levels of the balances increase. Because their customers are eligible to be participating in the draws if only they maintain a certain level of balance. But is there follow-up analysis to see, once such a scheme is stopped, who are the customers who are still sticky, whether the balances are still there, whether from a long-term perspective, the costs of such a scheme, did they pay out in increasing the stability of the funding from a long-term perspective? So such kind of analysis, take much more data and analytical capability. And then the next area is the new scenario analysis. So this we have already looked at, in terms of whether liquidity stress or changing scenario or oil price crash, any of these areas. So these are some of questions that can be easily answered if a bank has certain pillars, analytical pillars. So we will also look at what those pillars are, subsequently. And so integrated balance sheet origination, we've highlighted earlier. So it's largely whether the sales channels or the product managers are made aware of the riskiness in their products. Most of the times, the managers who are owning the products, they may have a good understanding of the geography or the demographics, or or have the skill of managing the sales channels, but more often than not, they lack the skill to identify whether in the current scenario this particular product, whether it is good or bad for the bank, in the overall scheme of things, or have an understanding of the inherent riskiness. So for example, something like, as I mentioned earlier, if you want to really grow in a segment like SME, there is no limit. I mean, banks can easily scale because these, I mean, at least in emerging economies, these are areas which are unfunded, or the level of accessibility to loans is very low. But there is a time where such a business can be grown, and there is a time where it needs to be avoided. So does the product manager have the right information to take those kind of decisions? Because when balance sheet plans are made, they are made for an year, and unless ALCO is doing a very active management of the balance sheet, the decisions that are taken at the start of the year seldom change, and because of which, even if the credit scenario looks like it's going to drastically turn down for certain segments, the decisions are still in place and the sales are still proceeding. So these are a few aspects that and again here, how can banks build capabilities to ensure that their sales channels have this kind of information? Either it could be regular training exercises, or of course, I mean, it has to come down from the level of ALCO, where there is an active way of managing the balance sheet, and then it has to flow down through active trainings or certain regular packs that are being circulated to these key people. And then further, are there systems to support these kind of analysis? If a product manager is given access to a system where he can readily assess if he grows this product by this much, how is it going to impact various aspects of the balance sheet, and if his incentives are aligned to such a growth. So those are some of the areas that banks can look into. So in the interest of time, I'll make it a bit more quicker. So I mean, at an overall level, I believe like a number of important aspects have been covered. So in the subsequent slides, we'll see how risk ties into this process and what are the challenges. So this is from a process and systems perspective. So this is a high level schematic of usually how a top down approach to business strategy works. What's the vision and mission, and what is the level of governance and appetite that the senior management has, and then how the risk appetite is defined, what are the targets for growth and returns, and then based on that, how the exact balance sheet composition and growth profile looks like, and then from there on the projections based on the assumptions, and then be able to measure whether the projections are in line with the the vision and the risk appetite, both in terms of capital, liquidity, interest rate sensitivity, any of the number of metrics that we have discussed that need to be incorporated in the risk appetite. So to enable such a process, this is, as you see, is a very time consuming process in most traditional banks. But to make it more streamlined, of course, it requires certain level of business process reengineering. But other than that, the core capabilities can be adopted, by planning or planning well on what kind of systems you acquire and how they can ease the various activities in terms of planning. So is there an integrated data model that stores all the information that is required for such a process? The current balance sheet and the projections, the risk factors and linkages, without which you'll not be able to say whether this kind of growth will lead to this kind of risk. The risk metric definitions, like LCR and NSFR, how would you project them? So you need to have the definition somewhere in the metadata. And the risk appetite, so as to ensure that the risk metrics are not going overboard. The various business scenarios that can materialize during the course of this projection, and all the other assumptions that go into making this kind of analysis, right from customer behavioral assumptions, interest rate projections, spread assumptions, so on and so forth, and price volume elasticity assumptions. So, if there is an analytical platform that can seamlessly integrate such a data model and then dynamically project the balance sheet, and also the NII and the risk metrics like capital, liquidity, etc. Whether a system is capable to project the provisions, that might not only come out of a simple growth assumption, but also based on the business scenarios, downturn, upturn scenarios. Whether there is adequate governance around those processes, and whether there are model validation processes that are governing the models that are embedded into such systems. So all these questions tie into the final integrated balance sheet planning. So these are the key pillars which I earlier mentioned. So starting from an integrated risk analytics framework, where you have a single analytical model of the balance sheet that can bring together your credit risk, liquidity risk, interest rate risk, FX risk, other pillar 2 risks like concentration risk, reputational risk, and other macroeconomic risks, and then use them to project the risk metrics. And a second pillar is on-demand performance view, whether you are able to get clear picture of the profitability of various business lines, various products, various segments, in a, probably obviously not in a real-time basis, but at least on a monthly basis, to be able to closely monitor if the direction in which these metrics are going is the right one or not, or whether they can give an early warning or early indication in terms of what's happening. And then the third aspect of what if analysis. So we've mentioned earlier that ALCO needs to be able to quickly turn around these kind of analysis. So whether there is analytical capability to do these kind of quick turnaround of scenario analysis. And given all these pillars, the final one would be optimization paths. So this is something even advanced economies and banks in Europe and US are looking at currently, whether they can use advanced algorithms to gather all the historical data that has been so far generated, and all the risk analysis, behavioral analysis that has been brought in, to make learning models that can project the right kind of asset allocations and growth assumptions that will optimize the balance sheet. So this is going into the territory of actively supplementing the capability of ALCO. But of course, this is evolution. None of this happens in one step. That it doesn't mean that you install a single system and all of this comes live. Obviously, there needs to be capability of absorbing this information. There needs to be capability of managing this kind of infrastructure, so on and so forth. But definitely there is a journey that can be taken. So this is the same thing that the details of that. So yeah, I think we'll take a pause here, and probably again I invite Mr. Kevin to give his views, and maybe Pratik to give a view of the time that we have.
Hi, Satya. So we have effectively, actually, we are reaching almost to the end of our session today. I think the topic is so wide that,
Yeah,
while giving the presentation, it can take much more than anticipated. What may I would request is if we can very quickly, maybe summarize the remaining part of the webinar,
yeah,
and then what we can essentially do is the questions that have been raised. We'll respond to those separately to all the attendees,
yeah,
so that at least we are able to complete the webinar. I think we might extend, if everyone's available, we can extend it for 5 more minutes just to
yeah.
complete the remaining part
Okay.
of the webinar. And in the end, we will also invite Mr. Kevin to sort of summarize his feedback on the whole presentation. So
Sure,
very
sure.
quickly, if you can
So what I'll
summarize.
do, yeah, in next couple of minutes, I'll summarize. So, we've talked about, various aspects of how risk links into this process. And here, of course, we are trying to, look at it primarily from, a risk management perspective, where traditionally you look at, even integrated risk management, where you have your governance, where you try to integrate the management of credit, market, operational risks, and do stress testing on capital adequacy and liquidity, and then how that feeds back into the governance. So the traditional picture does not show the strategy aspect, not the business planning aspect. So the key pillars that we mentioned earlier, so whether a business plan generated meets is in line with the appetite, whether it has taken into cognizance items like what will happen in times of stress, what will happen, whether all aspects of the obligations of the bank in terms of its plans, have they been covered. So those aspects don't come into picture. So that is where regulators have identified ICAP from a capital perspective and ILAP from a liquidity perspective. So these two frameworks are expected to bring in the strategy, the view of strategy and the business in the risk process. So just to give a summary of ICAP. So essentially, ICAP looks at assessing the capital adequacy of the bank, not just from the current perspective, also from a forecast taking into account its growth. And it also sets the brings various silos together in terms of challenging the assumptions, in terms of building the the numbers, and having discussions around the role of various departments within the process, and whether the final numbers make sense from a business perspective, or whether there is a difference in terms of what they have seen so far and what the ICAP process has brought out. And ICAP also strives to document the responsibility of board across various aspects of this process. And when we bring in the responsibility of board, so that is when the strategy is brought in. So that is where important decision, like whether the decision making in terms of credit and in terms of the capital growth, is it in line with the strategy? Do the decision makers have a clear view of the strategy? So ICAP therefore tries to articulate the strategy, focusing on the capital, and how it will have an impact on the capital. And usually ICAP is an annual exercise where some regulators also have a mid-year review or just the stress testing exercise. And ICAP not only brings in the assessment of the current picture, but also the stress aspect of capital. So under stress, what kind of in terms of a downturn, acute downturn or a long-term downturn, what kind of additional provisions can be expected, and what what kind of impact it have on the capital adequacy. ALCO plays a role of a reviewer in the ICAP process, where it can give guidance in terms of the extent of internal capital generation that the bank can achieve through the evolution of the balance sheet. Similarly, the ILAP. So I've already given a view of what ILAP is. Again, I'll not repeat myself. But the idea of ILAP is to establish a robust liquidity risk management framework to ensure that sufficient liquidity is available to withstand a range of stress events, and also the expenditure plans of the bank over the course of short to medium time horizon. So this gives a overview of the process adopted in integrated stress testing frameworks. I'll not go into too much details of this, and this is a kind of a workflow that how various risks link to each other, cross linkages, how cross linkages of the risk can be brought in into the risk management, as well as projections, both from how the cash flows drive the higher NII and the liquidity, and how the credit side of the story impacts the cash flows, and how both of them combined impact the capital, and how that in turn impacts various aspects like LCR, NSFR, capital adequacy, so on and so forth. So in terms of we was primarily in terms of challenges, analytical capability is something which most banks lack, because they're mostly tied up with legacy systems which are fit for purpose primarily from a regulatory reporting perspective and not from an analytical perspective. We have highlighted that timely reporting is an issue where a decision is made on at least a 1 month or 2 month lagged reports, and a lot of automation, low-hanging automation in terms of reporting is usually not in place. And of course, I mean, there are a lot of changes to regulations, so there's always a challenge to bring in the additional aspects. So you need to see whether your systems and frameworks are flexible enough to adapt to evolving regulatory landscape. And I mean, the fundamental challenge is the data. Whether there is a plan in place to drive towards a more streamlined process of building enterprise data warehouse of single truth. I mean, banks can be at various stages, but at least there needs to be key. The responsibilities need to be given, and the incentives need to be set to move in the direction, without which all these analytics will not be possible. So from my side, in terms of the closing remarks, so we have, as we just mentioned, COVID-19 materialized itself or manifested itself itself in a number of ways, in terms of the moratoriums offered to the customers, in terms of a lot of regulatory waivers, in terms of your capital and liquidity buffers, in terms of the liquidity, additional liquidity pumped in by central banks, government support programs, the kind of shocks that were witnessed in various macroeconomic variables, and sharp drop in interest rates. So a number of such items have come in together, and the question is, do banks today have, other than judgment, have a quantitative framework to incorporate all these materialized impacts and say whether the current scenario, with the current position of the balance sheet, is still in the green, and will it be green in the coming 3 months to 1 year, and whether the business plan makes sense given the scenario. So I mean, a few recommendations for banks as they seek for a path out of the pandemic. I mean, of course, the most important thing being maintaining the sanctity of the economy by ensuring that the franchise viability is continued, the products, the key, liquidity requirements or funding requirements of the economy are met. The recalibration of, so banks need to actively look at recalibrating their business plans, their recovery plans and stress testing frameworks. They need to ensure that even though on the funding side, there's not been significant challenges, but there's still a lot of volatility. So it is, prudent to increase the holding of liquidity buffer. And I mean, as we already highlighted, given the level of lower level of liquidity typically prevailing in emerging markets and currency markets, it becomes very difficult to manage the gaps. And all this is possible by the dynamic management of balance sheet by ALCO, which requires regular meetings and ability to perform integrated data analytics and frequent forecasting. So in sum, all this will require banks to enhance their analytical capabilities. There are a number of open source technologies available, powerful technologies available that banks can look into to gradually build the capability and take decisions that are the right choice to get out of this pandemic in a single piece. So with that, from my side, I conclude. Apologies for going over the mandated time. So and at this time, I offer the floor to Mr. Kevin to give his concluding remarks.
Satya, thank you very much. This has been a very interesting session for me, and I'm sure for all the participants. I just have a few remarks to make. First of all, I think you've laid very, very solid argument for some kind of dynamic balance sheet management. We need that rather than the periodic assessments that we do from time to time through the ALCO process. I mean, as a chief risk officer, nothing will excite me more than to sit down and see what's going on a daily basis, or at any time I want to see what's going on. I want to see what we're exposed to, what are the stress scenarios, what should be our response and stuff like that. So nothing will excite me more than that. And you've made a very solid case for that. And I'm very sure everyone listening agrees with you. Now, it's a journey. My comment would be that it is a journey. And as I speak, I'll also try to address more of the questions that were some of them that were raised. I think it's a journey, and being a journey, you stand the risk of taking a solution that might be too big or too much for the size. So you have to adapt the solution you're implementing to the size of your operation, and that's very, very important. For example, when if I take an aspect of risk management that we have in Fidelity Bank, which is credit risk management, we first started with an in-house developed solution for loan origination. So it just kept growing as we're growing, it kept growing with us. And then we got to the point where we felt, oh, this can't take us further. And then we're not going for something else that would have a lot more functionality. So that approach of taking it bite size is very, very important. And so that we grow the process along the way. Now, a fundamental building block to anything about balance sheet management in any wise is data. Data is fundamental. And that's a challenge we have across most banks, in Nigeria and outside Nigeria. And without that, you can't really do these things well. It wouldn't make sense. If you have the best solution and then you have wrong data, it becomes garbage in, garbage out. So you have to make sure the data foundation is right and proper. And I think that's a key first step that every institution needs to take. We in Fidelity recognize that, and we've already started working on that to ensure that we have the right foundation to enable us get into this this next level of integrated dynamic balance sheet management. Now, obviously, you can't do this all by yourself. Sometimes, as a bank, we're all too busy running around, fighting one fire or the other. It's either you are responding to the CBN telling you about cash reserves. When you take deposits from customers, they take a part of it, a large part of it, and sterilize it. You can't use it. And then at the same time, you are being asked to lend more. There's a minimum loan to deposit ratio that you must meet. So those conflicting things, you are busy trying to manage them. And then COVID comes up and you have all kinds of stress scenarios coming up and you need to keep looking at them. So you are too busy. And sometimes you do need external help to, put you through, walk with you, and see all the things you can't see on a day-to-day basis, and then arrive at a solution. And I think that's where partners like Activa and others like them can probably provide that kind of guidance. So in summary, I would say that there's a need to have a partner that would work with you, not with the objective of selling you a Rolls Royce when all you need is a Beetle, but with the objective of giving you a Beetle and then gradually building you up till you can get to use a Rolls Royce. And that's very fundamental. So I want to thank you again, Satya, for this presentation. And of course, Riemann.
Thank you very much for your kindness.
These are my few closing comments, and I want to thank everybody too who has been on this. Thank you very much.
Thank you so much, Kevin. I think as a perspective coming from a banker, adds value to what we have been trying to sort of promote and sort of also educate and bring in more understanding on aspects of bringing liquidity and capital management into your day-to-day or yearly strategy. With that, I would like to thank Satya and Kevin and for joining us today. I think we exceeded a bit, but I feel we didn't realize how the time went because it was so engrossing on the subject matter given by Satya. We apologize for the delay, but I hope it was worth 15 extra minutes. So thank you so much. We will be, sort of responding to the questions that been raised via email to all the participants. And we will also share a copy of the webinar presentation to everyone for follow-up. And we'll be posting this webinar on our YouTube channel for anyone else to refer back to. Thank you so much, everyone. With this, I would like to end the webinar. Thank you.
Thank you.
Thank you. Thank you very much. And bye-bye, everyone. Bye.